Right now, liberal arts, and particularly the classics, are getting killed across American universities. You're at Penn. It's truly definitive under classical studies. Defend right now the value you got out of a classical studies education to get you to worry about duration and convexity.
So there are many other things you study at university, and I did a lot of sciences, which ultimately helped me with bond math. But I always thought of classics as my avocation while I was studying other things that I knew would lead to a vocation. And I think if you get that balance, it makes for a far better university life.
I totally agree in the strongest sense. Did you study Latin and Greek? Are you like former Prime Minister Johnson, where you can waltz right now into Latin or Greek?
Arma virumque cano Troiae qui primus aboris.
Can we get that tape? Bob, Robert Brockton, can you be sure that we get that tape here?
Do you want it in group? Few ti pate gegene.
There again, you go. Please?
Few ti pate gegene. Thrasymachus. There you go. You learn it, you never forget it.
That's great. Paul, can you save the damn interview?
Well, I can save it because he also got a CFA. That got him to where he is today, so we're in good shape. So, Bob, what do we do here? I mean, we're going to get a big inflation print tomorrow. A lot of folks are trying to figure out what this Federal Reserve is going to do. It seems like, March off the table, May, not sure. Maybe push it back to June for a rate cut. How are you guys at Morgan Stanley thinking about this?
Honestly, Paul, I just want to enjoy the soft landing.
Okay.
We're in the midst of it now. We've got very low unemployment. We've got stable inflation. We look at the 6-month annualized rate of core PC. It's currently 1.9%. Tomorrow we'll likely get a 0.4. We'll push it up to 2.4. It's okay. It's in touching distance of 2%. You go back a few years, it was 6.6%. So I think the Fed is right to just pause here. I think if they look at inflation on a shorter term basis, they have to be real happy with it. But they were late to hiking rates, thinking inflation would be transitory. They can't make that mistake again. So June still looks like ours and everyone else's central case.
All right. I said Morgan Stanley, of course, at JPMorgan. It's all Morgan's, at some point in time.
Back when it probably was.
Back in the day when it was. So, I mean, you think about this market. I'm looking at INGO on the Bloomberg terminal. That's the Bloomberg index browser, and you get all the fixed income indexes, most of which Bloomberg owns. We're in the red this year. 2022 was just brutal for the fixed income market. A little bit of performance last year thanks to November and December. Yep. Now where do I go in the fixed income space? What are you walking around the trading floor? What are your traders doing? So
there are a couple things. And I was out at a dinner last night with about 50 financial advisors, and we were talking about this. And my greatest concern is not that the market rallies to 1%. I don't really want that. I'd rather have the market back up to about 5% to give more investors an opportunity to get into the market. And I think when you look at the amount of money in money market funds, it's 5.5%. People want to get in. They want a slightly higher yield. You look at pension funds, they want a slightly higher yield. I look at the aggregate bond index. At the end of December 31, 2022, it was 4.67% yield, 4.7%. And we were looking at 4 additional rate hikes at the start of 2023. This morning, 5.0%. So you're up about 30 basis points, and we're looking at 3 to 5 rate cuts this year.
And Michael Ferroli is going to tell you we're a long way from potential GDP, and for whatever reason, let's say the stimulus, whatever. But I'm just imagining. I mean, the new Park Avenue offices at JPMorgan.
Oh boy!
Jamie will have a lunch up in the girders, like it's like one of those photos, black and white.
Can't wait to get inside that building.
He'll go, Bob, come on up with me and sit on a girder.
Come and broadcast from there.
We'd like to do it. Seriously, I'd like to do that. You line up you and Mr. Diamond, and the number one question Mr. Diamond's going to have for you or his team is all this cash that's out there. How does Bob Michaels think the deployment of trillions of dollars of cash at the margin will occur?
Well, I think it's going to go into a lot of different places. First, I think a lot of it will stay where it is because you get a yield on cash, which you didn't get before. And, the Fed cuts rates a few hundred basis. Let's say they take it down to 3%. You're still going to get a yield on cash of about 3%. I think a lot of it's coming into the bond market. Everyone is waiting for the Fed to cut rates.
Right.
That makes cash less attractive. That's where a lot of it goes.